Hi, this is Prios. Today I want to bring you a different topic than in my last videos. Today I want to talk about a stocks market related topic. I want to compare growth and dividend stocks, and in order to do that I built three different models. The first model will be without taxes and without transaction cost. The second one will be with taxes but without transaction cost. The third one will be including both taxes and transaction cost. My models are built in Excel, and for our models we will look at two different stocks. Stock A, the dividend stock, is paying the shareholders only through dividends. Stock B, the growth stock, is not paying any dividends. Instead, they will reinvest the profits, and this will be reflected in a rising stock price. Both stocks have the same yield of 10% per year, and we will hold our investment for 30 years. We will start with 100 euros in every example, and both stocks will be offered at 1 euro in year 1. Now let's move on to our first model, that is a world without taxes and transaction cost. To be able to compare the stocks, we must assume that the dividend payments get reinvested in every year. So we are doing the calculations for all the years, and we find out that in a world without taxes and transaction cost, the return of both investments are the same. So we will have approximately 1,586 no matter in which stock we put our money. Now let's move on to the next model that adds taxes. We assume a tax rate of 25% on dividends and also a 25% tax rate on returns created by selling stocks at a higher rate than you bought them. Again, the dividend payments will be reinvested in the stock. We will assume that the tax will be due when you realize your profits. In this case, that will be when you receive your dividend payments or when you finally sell your stock after 30 years. So after doing all the calculations, we find out that stock B, the growth stock, has a lot better returns than the dividend stock. The difference between them is about 400. And in both cases, we get lower returns because now the government is taking away a piece for stock A and stock B. But why do we get an advantage in stock B? We gain an advantage because the tax is shifted into the future and our capital can grow without having any deductions in between. That is the compound interest effect, which is reducing our effective tax rate for stock B. We don't have to pay taxes every year like for the stock A and their dividend pay. We just pay taxes after 30 years when we terminate our investment. In the real world, we often prefer an increase in stock's value over dividends even more, because often long-term investments are rewarded with a lower tax rate. In some countries, the price gains are even free of charge if you hold your investment for at least a certain amount of years. Now let's move on to our last model. In model 3, we will now also add a transaction fee of 1%. The dividends will be again reinvested, and we also assume that the dividend payments will be free of transaction cost but will get taxed. Our tax rate again will be 25%. Adding transaction has the following impact on our investment. We will lose value for both because we now have to pay additional fees to our broker. Again, the dividend stock suffers more from the inclusion of transaction cost than the growth stock. We again have the advantage from the tax shifted into the future, and in addition to that we also have to pay lower transaction cost because We only pay transaction cost 2 times, at the end and at the start of our investment. For the dividend stock, we got additional cost in between when we reinvest our dividends. Now let's come to the conclusion. In a perfect world without tax and transaction cost, it doesn't matter in which stock we invest our capital. Taxes have a great impact and let us prefer a value increase over dividends. The existence of transaction cost makes us prefer price growth even more. I hope you found it informative and liked my video. If that's the case, please subscribe and/or like. Bye. And thanks for watching.